Here's what's scary about passing the $2 million mark for retirement. You are now wealthy enough that the government, financial institutions, and the market are all working to take it away from you. Even worse, most financial advisors will probably be giving you advice built for $500,000 portfolios. At $2 million and above, you don't have a retirement problem. You really have a wealth preservation problem. In this video, I'm going to show you the critical mindset shift required at the $2 million level, the 5 biggest traps that catches retirees at this wealth level off guard, and I'll walk you through a clear 4-pillar framework to maximize and protect your retirement wealth. The $2 million threshold can be a bit of a game-changing amount, but here's what no one tells you. The same milestone that gives you the freedom also creates new retirement complexities. A study conducted by the Alliance for Lifetime Income found that nearly half of retirees, or about 46%, say that spending their savings causes anxiety in retirement. Even with more wealth, the emotional pressure doesn't disappear. It just shifts from, do I have enough, to how do I not lose it? We're talking about more sophisticated tax planning requirements, potential sequence of returns risk, government benefit clawbacks, and legacy planning issues. The good news? When you understand these challenges, you can turn them into opportunities. So let's dive into the 5 traps that you should avoid if you have over $2 million saved for retirement. Now, the first trap is not knowing your true number. Now, what I mean by that is people tend to chase round numbers. Maybe it's 1 million, 2 million, or maybe $5 million without any real clarity on what they actually need to support the lifestyle that they want. I talk about this all the time on my channel, but here's the truth, right? Your number is deeply personal. It depends on your lifestyle goals and the desired retirement activities that you want to pursue. It depends on your actual expenses, not what you think you'll spend or what you're spending today, but what you'll actually spend in retirement, right? One example of that is when people look at how much they spend on healthcare while they're working, they're quite sticker shocked by how much healthcare can cost, whether it's Medicare or pre-Medicare health insurance, which can often be times upwards of double the price of your Medicare out-of-pocket expenses. You also have to look at your fixed income sources. Do you have Social Security? Do you have pensions or rental income? If you do have a pension, I highly recommend subscribing because my next video I'm doing is all about pensions. And I think you'll find a lot of value in that. Just a little plug there. But without this clarity, the anxiety really never goes away. So you'll continue constantly asking yourself, do I have enough? Or am I going to potentially lose this amount that I have saved over a 25 or 30-year retirement if I live long? And here's the irony. By the time you finally get enough or feel like you have enough, if you don't know your true number, there's a good chance that you might have too much. And you might have actually lost out on some of the best years of retirement that you could have been enjoying instead of grinding away at work potentially. Now, the second trap is the ticking tax time bomb. Now, what I mean by that is for a lot of people who do have $2 million saved, they tend to run into serious trouble when they're heavily concentrated in pre-tax retirement accounts, such as IRAs or 401k accounts. In the US, once you hit age 73, and in 2033, it will be age 75, required minimum distributions or RMDs kick in. These force you to take out taxable income from your pre-tax retirement accounts, whether you need it or not. And it's often above your actual spending level of what you need. The consequences cascade quite quickly. You can get pushed into higher tax brackets. Up to 85% of your Social Security benefit income could be taxable. You could be looking at potential IRMA surcharges, which increase your Medicare premiums. And you may even trigger net investment income tax or NIT. So some different taxations and issues that you need to be aware of when you have a portfolio size over $2 million. Now, I do want to be clear, RMDs aren't the retirement destroying wolf that many retirees and even some advisors make them out to be. Stick around because at the end of this video, I'm going to link to my other video where I debunk the common myths of RMDs and share specific strategies that you can use if you have a majority of your retirement savings in qualified accounts. Now, the third trap is portfolio misalignment. And what I mean by this is at the $2 million level, mistakes in your asset allocation get amplified dramatically. Think about a 20% market drop equals $400,000 loss. That's both a psychological shock and a real financial setback for a lot of retirees. And the risk does run both ways, right? If your portfolio is too aggressive, you could be growth chasing and exposed to potentially devastating sequence of returns risk earlier on in retirement. But at the same time, if you're too conservative with your portfolio, you might feel safe in the short run, but you're quietly losing ground. When your money doesn't keep up with inflation, especially some of the inflation rates that we've been seeing over the past couple of years, it buys less and less over time. In plain English, what costs you $1 today could cost you $2 or more by the time you're deep into retirement. meaning that $1 sitting in cash might only have the buying power of 50 cents later on. I hope that makes sense. Now, the solution here is a balanced portfolio with 3 layers. The first layer can be your stable foundation, a reasonable allocation to safer investments like cash, short-term treasuries, maybe tips, or gold. Then you have your layer of income buffer. And these are going to be your investments that provide stability for your withdrawals, especially if the market is in a downturn, such as investment grade fixed income, or specifically intermediate or longer term bonds as well. And then you have your growth engine allocation, which is the remaining assets that stay invested for longer term appreciation through growth oriented investments. Maybe it's going to be value or growth equities, value or large cap growth equities, potentially complemented by a smaller allocation to more speculative growth assets like crypto ETFs if you're comfortable with the higher volatility. Of course, this isn't investment advice or any recommendations, but generally this structure can help you weather market storms, but while still capturing market upside. And our fourth trap is industry targeting. You see, once you cross the $2 million mark, you've been an accredited investor for some time now, depending on your income. So get ready for the different investment pitches that might be coming your way or have already been coming your way. These exclusive private equity deals or real estate syndications or maybe alternative investment funds. They're going to make it sound like you're missing out if you don't participate. But the problem is usually threefold, right? These investments tend to be very illiquid. So your money gets locked up for several months or maybe many years. In the case of certain private equity deals, you're looking at higher fees, which will obviously, of course, eat into your returns. And a lot of times that there's misaligned incentives. Like a lot of these, they actually they're better for the promoter and more questionable for the investor at times. So those are just 3 kind of very high level blanket looks at kind of special investment deals that may sound sexier than they appear. The solution, in our opinion, is investment clarity. You need a systematic process to be able to evaluate and frankly, usually decline these type of investment distractions. Here's what the data actually shows, right? It's lower cost index funds, ETFs, and individual stock strategies that have consistently outperformed overly active managed alternatives over time, whether it's mutual funds, private investments, direct investments, or anything like that. Simple isn't sexy, like I said, but it often can be much better for your longer term wealth. And our fifth and final trap is legacy blind spots. Here's a sobering reality. At $2 million and above, your wealth often exceeds what you'll personally consume in retirement. That's good news, unless you fail to plan intentionally, of course. Without proper legacy planning, 70% or more of family wealth dissipates by the second and especially third generations. So your hard-earned assets can oftentimes create more problems than solutions for yourself and your heirs. Tax inefficiencies erode the wealth that you worked to a lifetime to build. Now, the solution to this at a very high level is one, to really take an active role and educate your heirs on financial stewardship so that they'll actually be prepared to handle your inherited wealth. And it's not just a windfall that kind of lands in their lap. The second is to blend charitable giving with your tax strategy for maximum impact, both on your tax return, but also for the charities that you care about and you support. And the third is to structure your inheritance intelligently, whether that's using proper beneficiary designations, which I always recommend reviewing at least annually or maybe every 2 years, just to make sure nothing's changed in your life that needs to be reflected on your beneficiary designations. You can use Roth accounts, whether conversions or if you're able to contribute directly to a Roth account. That way you have tax-free inheritance for your beneficiaries, and also use trusts where appropriate, whether avoiding probate or managing assets after you're gone. Remember, legacy planning isn't just about passing money. It's about passing values and creating a lasting positive impact for those that you care most about. Now, let's talk about the 4 pillars of our $2 million retirement framework, like I mentioned. At Peak Financial Planning, we've developed a 4-pillar framework specifically designed for families of this kind of wealth level. So the first pillar is going to be determining your retirement lifestyle, right? This is where everything starts. And a lot of advisors kind of just skip right past it. It's critical to begin from a position of clarity of what you really want and what you want your lifestyle to be in retirement. That vision should lead all the calculations and all the different strategy recommendations in your financial planning process, not the other way around, right? Now, the second pillar is going to be identifying your spending number. For instance, using our custom risk-based guardrails approach, you'll be able to identify how much you can safely spend in retirement, because that's an important number, and how much you need to temporarily reduce your spending if the market pulls back, and by how much and for how long. And that's really the key, right? Many retirees don't realize that they can actually spend a lot more earlier on in retirement if they're willing to be flexible and stay on top of spending adjustments, depending on what the market does and what happens in their own lives. And then third is looking at what adjustments that you can make to maintain your lifestyle throughout different market conditions. And this spending number that I'm talking about really becomes your retirement paycheck. It's what's going to give you confidence and the flexibility and not make you adhere to just rigid formulas like the 4% rule that don't really match reality or your lifestyle. And now the third pillar we have is selecting and implementing retirement strategies. And this is where we get tactical. And you'll notice that a lot of people like to jump right to these strategies, but they're not doing pillars 1 and 2, which is kind of the foundational work that needs to be done before you can review and implement retirement strategies. Like Roth conversions, maybe it's qualified charitable distributions, QCDs, or tax loss harvesting or tax gain harvesting, depending on the tax bracket you're in. All these different strategies, I call them like kind of tier 2 strategies, should support your retirement plan, but they certainly shouldn't be your entire plan. I hope that makes sense. And this is where, we work together and determine your sequence of withdrawals to make sure that you're being as tax efficient, pulling your income as you can. We'll review the effectiveness of Roth conversions based on a multitude of factors, such as your longevity expectations, other income sources you might have, the spending level you're at, your current health status, and potentially expected market performance. It's these strategic decisions that will help you compound your wealth over decades in retirement, rather than kind of jumping and trying to build on a faulty foundation. And our fourth pillar is going to be your investment alignment. Only now, after we've established your ideal lifestyle, your spending plan, and your different tax and retirement strategies, do we then start to look at your investments. And I believe that this is how it should be. This is where we determine, 1, your ideal market risk participation level and where that needs to be to support your plan. 2, your strategic asset allocation, and then proper asset location, making sure that we're investing the right type of investments in the right type of accounts. Again, just trying to be as tax efficient as possible. And so I really want to kind of wrap this with a bow by saying that the sequence in this framework really does matter, right? Investment decisions without proper foundation planning done first can lead to anxiety and oftentimes poor outcomes. And then the fifth and final pillar is going to be your legacy alignment. So once all these different tactical strategies and decisions and the investment process are in place, it's then critical to make sure you take a step back and ensure that your wealth is protected across multiple generations and that you're able to maximize your impact, both while you're living and after you pass. You see, our motto at Peak is live rich, don't die rich. Now, of course, if you want to die with as much as you can in the bank, that's one thing. But if it's not intentional and you'd rather, live fully during your life, which frankly are the types of families that we work best with, this is the type of framework that's going to allow you to do that. And so that's going to mean enjoying the assets that you accumulated while you're still young and you're still healthy. Maybe it's gifting to family or charities that you care about so that you can witness their delight while you're still living and see the impact that your generosity is making. Or maybe it's creating a legacy of values and not just passing on assets to your children and grandchildren potentially. So reaching the $2 million mark doesn't mean the end of your money worries. It simply means that you've entered a new stage with potentially a new set of rules. With a clear framework in place, you can really turn the financial complexity into confidence. You can protect your wealth from unnecessary risk and truly enjoy the freedom that retirement can bring. Most importantly, you can create a lasting legacy that reflects your values and supports the people and the causes that you care most about. Like I mentioned earlier in this video, if most of your retirement savings are in pre-tax accounts like an IRA or a 401k, click the video that I'm attaching here where I debunk some of the most common myths about required minimum distributions or RMDs and share a few practical strategies that you can use to help reduce the taxes in your retirement. I hope you find that video valuable. I hope you found this video valuable, and I'm excited to see you in the next one. Thanks.